everybody. I am Joe Gallimore, Director of Investment Management with Argent Bridge Advisors. Thank you back for another cup of Joe. And I think in this edition, we are going to do something a little different. I'm going to briefly fill you in on the recent market activity, but then we're going to do sort of a classroom style discussion on a buzzword you may hear floating around the financial media nowadays. So real quick, markets rallied during the short Labor Day week on thoughts that the stock market may have been oversold after a 3-week slide, and also on hopes that the August data figures would signal some more easing of the inflation numbers. Now, alas, hopes were dashed this week as it was reported that inflation actually held steady through August. Which means that the Federal Reserve's policy of aggressive interest rate hikes will proceed as planned. Now, this is a path that we know by now is not favored by stock markets or bond markets. So alas, the volatility continues. Now, the silver lining here is that with widespread volatility, this presents more buying opportunities for the actively managed strategies we incorporated for you all. Now, we're going to briefly discuss a topic you may be hearing a lot in the financial media, which is stagflation. Stagflation is a term that's actually a contraction of the words stagnant and inflation. So we're going to start with the second part first. By now, we all generally know what inflation is. It's when prices go up. And in most scenarios, inflation comes about due to natural economic forces, and I use natural in a almost purely academic sense anyways. Some examples of natural economic forces would be more dollars in the economy. In a strong or growing economy, more people are employed. This puts more money into the pockets of consumers, more money is spent, and prices go up. Or it could be due to some supply and demand dynamics. If demand for a specific product or service becomes particularly popular, more people want that, so price goes up. So that's inflation. We're all pretty familiar with that by now. Now, the other part of this funny sounding term is being stagnant or in a state of stagnation. This refers to economic activity, or more specifically, economic growth. And simply put, it's when the economy is slowing down or even contracting. Periods of stagnation, they're typically accompanied by some unpleasant trends, namely rising unemployment and decreasing business profits, which has a negative effect on investment returns. So when you put these two together, stagnation and inflation, you get prices rising while the economy is slowing down. Stagnation. Not fun. During this period, inflation is making life more expensive for everybody, while economic slowdown may lead to wider job loss or poor investment returns. Now, stagnation doesn't happen often. And when it does, it seems to be related to some sort of external shock to the economy. Now, many of you watching may remember the 1970s, when growth was stifled due to monetary policy and fiscal policy put out by the government. But all that was compounded by very high inflation that was caused by an oil embargo, which was brought on due to political alliances. This time around, the COVID pandemic and war has caused unprecedented disruptions and interruptions in the global supply chain, which is stalling out lots of economic engines worldwide. Not only did that drive up prices, but central banks around the world adopted policy and reactive actions to this economic slowdown. They all injected eye-watering amounts of cash and liquidity into financial systems everywhere to prop up those economies. These are major inflationary forces. So here we find ourselves in the midst of these effects that have been boiling up over the last 2 years. Now, to slow down these price increases, the Fed has to tighten the screws by raising interest rates. Now, this has a knock-on effect of also slowing down the business activity in a global economy, which has been dealing with intermittent shutdowns for these past 2 years. So this is the double whammy of stagflation and why we're hearing about it as a buzzword in such a negative sense. And the last point I'll mention about stagflation is that it's really more of a decision as opposed to a formula as to determine whether stagflation is present. It won't be officially known whether it's here or not until much later. But the one thing that's undeniable is that the components of stagflation are certainly present. So while the Fed does what it can to turn things around, and capitalists all around the world remain resilient and persistent with their activity to persevere, we here at Argent Bridge recommend that you, as the investor, always stay invested so that you don't miss the inevitable market recovery when things finally do turn around. So if you have any questions about stagflation or about current market returns or about any other topic relating to your financial well-being, please let us know. Take care.